My dear students, welcome back to our channel. In this video, I will be explaining the BBA third semester subject Financial Management as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 1 first important short question is: define finance and discuss its relationship with other disciplines. Finance is the study of how individuals, businesses, and governments manage money, investments, and resources. It helps in planning, raising, and using funds efficiently to achieve goals. In simple words, finance is about getting the right amount of money at the right time and using it wisely. Finance is closely linked with other disciplines. 1. Economics. Finance uses economic principles to understand market behavior, demand, supply, and interest rates. Example: deciding whether to invest in a business depends on economic growth. 2. Accounting. Accounting provides financial data like profit, loss, and assets, which finance uses for decision-making. Example: a company checks its balance sheet before taking a loan. 3. Management. Finance supports planning, organizing, and controlling business activities. Example: budgeting for production or marketing. 4. Statistics and mathematics. Finance uses them for forecasting, risk analysis, and investment calculations. In short, finance is a central tool that connects money management with other fields to make smart financial decisions. Next important short question is: 2. What is the importance of financial management? Financial management, FM, is crucial for the smooth running of any business because it ensures that money is available when needed and is used efficiently. Its importance can be understood in the following points. 1. Proper fund utilization. FM helps in allocating funds to the most profitable areas. Example: a company may invest more in high-demand products to earn better returns. 2. Planning for future. FM allows businesses to plan for growth, expansion, and emergencies. Example: setting aside funds for new machinery or unexpected repairs. 3. Profit maximization. By making smart financial decisions, FM helps in increasing profits. Example: choosing the right investment that gives higher returns. 4. Avoiding financial risks. FM identifies and reduces risks related to borrowing, investments, and operations. Example: diversifying investments to avoid losses. 5. Supports decision-making. FM provides accurate financial information to help managers make wise decisions. In short, financial management ensures financial health, growth, and stability of a business. Next important short question is: 3. What are the objectives of financial management? The main goal of financial management, FM, is to ensure that a business uses its money in the most effective way to achieve its objectives. The key objectives are: 1. Profit maximization. FM aims to increase profits by making smart investment and spending decisions. Example: investing in a high-demand product rather than a slow-selling one. 2. Wealth maximization. The ultimate goal is to increase the value of the business and shareholders' wealth. Example: choosing long-term profitable projects even if short-term profits are lower. 3. Ensuring liquidity. FM ensures that the company always has enough cash to meet day-to-day expenses. Example: maintaining enough cash to pay salaries and suppliers on time. 4. Risk management. Identifying and minimizing financial risks related to investments, borrowing, and operations. Example: diversifying investments to reduce loss. In short, FM balances profit, wealth, liquidity, and risk to ensure business growth and stability. Next important short question is 4. Explain the modern approach of financial management. The modern approach of financial management, FM, focuses on maximizing shareholders' wealth rather than just earning profits. Unlike the traditional approach, which only aimed at profit maximization, the modern approach considers risk, time value of money, and long-term business growth. Key features of the modern approach. 1. Wealth maximization. The main goal is to increase the market value of shares for shareholders. Example, investing in a project that may take time but gives higher returns in the long run. 2. Risk and return consideration. FM evaluates both expected returns and associated risks before making decisions. Example, choosing a moderate risk investment that balances profit and safety. 3. Decision-oriented, focuses on investment, financing, and dividend decisions to achieve long-term financial stability. 4. Future planning, helps in strategic planning for expansion and growth. In short, the modern approach is practical, long-term, and shareholder-focused, making business decisions more effective and sustainable. Next important short question is 5. What do you mean by financing decision? Explain. A financing decision is a key part of financial management, FM, that deals with raising funds for a business and deciding the best way to finance its activities. It answers questions like, where should we get money from and how much debt or equity should we use? Key points. 1. Sources of finance. Funds can come from owners, equity, borrowed money, debt, or internal funds, retained profits. Example, a company may issue shares to raise capital or take a bank loan for expansion. 2. Decision balance. FM ensures a balance between risk and cost of capital. Too much debt increases risk, while too little may slow growth. 3. Long-term impact. Financing decisions affect profitability, financial stability, and shareholder wealth. In short, a financing decision ensures the business has enough funds at the right cost, supporting growth while managing risk. Next Unit 1. Long questions. First important long question is 1. Explain the concept of profit maximization versus wealth maximization. In financial management, FM, businesses aim to make decisions that improve their financial position. Two important concepts that guide these decisions are profit maximization and wealth maximization. 1. Profit maximization. Profit maximization means making decisions that increase the company's short-term profits. The focus is on earning the highest possible profit in a particular period, usually a year. Example, a company may sell a product at the highest price to earn more profit, even if it risks losing some customers. Advantages: simple to calculate and easy to understand. Limitations: ignores risk. High profit may come with high risk. Ignores time value of money. 1 rupee today is more valuable than 1 rupee in the future. Focuses only on short-term gains, not long-term growth. 2. Wealth maximization. Wealth maximization focuses on increasing the overall value of the business, usually measured by shareholders' wealth or market value of shares. The goal is long-term growth rather than short-term profits. Example, a company may invest in a new project that takes 3 years to generate returns. Although profit is low initially, the project increases the company's value in the long run. Advantages: considers risk and time value of money. Focuses on long-term growth and sustainability. Aligns with shareholders' interests, making it more realistic. Comparison table. Aspect: profit maximization, wealth maximization. Goal: short-term profit, long-term shareholder wealth. Risk ignored considered. Time value of money ignored considered. Decision making short-term focus long-term focus. Example raising prices to increase current profit investing in long-term projects for higher future returns. Conclusion. While profit maximization is easier and focuses on short-term gains, wealth maximization is a modern, practical approach that considers risk, time, and shareholders' long-term interests. Today, financial managers prefer wealth maximization as it ensures sustainable growth and maximum value for shareholders. Next important long question is: 2. Define financial management. Should the goal financial decision-making be profit maximization or wealth maximization? Define financial management. Should the goal of financial decision-making be profit maximization or wealth maximization? Financial management, FM, is the process of planning, organizing, controlling, and monitoring financial resources of a business to achieve its objectives. It helps in deciding how to raise funds, where to invest them, and how to use them efficiently to ensure financial stability and growth. Simply put, FM is making smart money decisions to support business goals. Goal of financial decision-making. Traditionally, the main goal of financial decisions was profit maximization, which means earning the highest possible profit in a short period. Example, a company may focus on selling products at high prices to earn maximum profit this year. Limitations of profit maximization. 1. Ignores risk. High profits may involve high uncertainty. 2. Ignores the time value of money. 1 rupee today is worth more than 1 rupee in the future. 3. Focuses only on short-term gains, ignoring long-term growth and sustainability. Because of these limitations, modern financial managers prefer wealth maximization as the main goal. Wealth maximization. Wealth maximization aims to increase the overall value of the business and shareholders' wealth. It considers risk, return, and time value of money, making it more realistic and long-term oriented. Example, investing in a new project that may take 3 to 5 years to generate returns. Although short-term profit is low, the market value of the company increases, benefiting shareholders. Advantages. Considers both profit and risk. Focuses on long-term growth. Aligns with shareholders' interests. Conclusion. While profit maximization is simple and short-term focused, wealth maximization is practical, risk-aware, and long-term focused. Today, financial managers prefer wealth maximization as it ensures sustainable growth, stability, and maximum value for shareholders. Next important long question is: 3. Define business finance. What are the responsibilities of the financial manager in a modern business organization? Define business finance. What are the responsibilities of the financial manager in a modern business organization? Business finance refers to the planning, raising, and managing of funds for a business. It is a part of financial management that deals with how money is obtained, allocated, and used efficiently to achieve business objectives. Simply put, business finance ensures that a company has the right amount of money at the right time for smooth operations and growth. Example, a company planning to expand its factory needs funds. Business finance decides whether to use internal funds, profits, issue shares, or take loans to finance the expansion. Responsibilities of a financial manager. The financial manager is responsible for managing the company's funds in a way that maximizes wealth and ensures stability. Key responsibilities include: 1. Investment decisions. Capital budgeting, deciding where to invest funds for maximum returns. Example, choosing between buying new machinery or investing in marketing campaigns. 2. Financing decisions, deciding the best source of funds, equity, debt, or retained earnings. Example, raising money through a bank loan versus issuing new shares. 3. Dividend decisions, deciding how much profit to retain in the business and how much to distribute to shareholders. Example, retaining earnings for expansion instead of paying high dividends. 4. Working capital management, ensuring sufficient liquidity to meet day-to-day operations. Example, managing cash, inventories, and receivables efficiently. 5. Financial planning and control, forecasting future needs, preparing budgets, and controlling financial risks. Example, monitoring monthly expenses to avoid overspending. 6. Risk management, identifying and minimizing financial risks related to investments, borrowing, and operations. Conclusion. In short, business finance ensures funds are available, used efficiently, and managed wisely. A financial manager plays a vital role by making smart decisions about investment, financing, dividends, and working capital, ensuring long-term growth, stability, and shareholder wealth. Next important long question is: 4. Discuss in detail the functions of financial management. Discuss in detail the functions of financial management. Financial management, FM, is responsible for planning, organizing, controlling, and monitoring the financial activities of a business. Its main aim is to ensure that funds are available, used efficiently, and generate maximum returns. The key functions of financial management are: 1. Investment or capital budgeting decisions. This involves deciding where to invest the funds to earn the best returns. Example, a company may choose to invest in new machinery, expansion of a factory, or a profitable project. The decision must balance risk and return. 2. Financing decisions. This deals with raising funds for the business and selecting the best mix of debt and equity. Example, a company may raise funds through a bank loan or by issuing shares. Proper financing reduces cost and financial risk. 3. Dividend decisions. Financial managers decide how much profit to retain for growth and how much to distribute to shareholders as dividends. Example, retaining earnings to expand production instead of paying high dividends to shareholders. 4. Working capital management. Ensures the company has enough short-term assets like cash, inventory, and receivables to meet day-to-day expenses. Example, maintaining sufficient cash to pay salaries and suppliers on time. 5. Financial planning and control. Involves forecasting future financial needs, preparing budgets, and monitoring performance to avoid overspending. Example, preparing a yearly budget to control costs of production and marketing. 6. Risk management. Financial managers identify and reduce financial risks in investments, borrowing, and operations. Example, diversifying investments to minimize losses in case of market downturns. Conclusion. In short, the functions of financial management cover investment, financing, dividend decisions, working capital management, planning, and risk management. By performing these functions effectively, a business can grow sustainably, manage risks, and increase shareholders' wealth, ensuring long-term success. Next important long question is: 5. Explain current assets management decision, dividend decision, and organization of finance function in a modern business. Explain current assets management decision, dividend decision, and organization of finance function in a modern business. 1. Current assets management decision. Current assets management focuses on managing short-term assets like cash, inventory, and receivables efficiently. The goal is to maintain liquidity while maximizing profitability. Example, a company ensures enough cash to pay salaries and suppliers, keeps optimal inventory to avoid overstocking, and monitors receivables to get payments on time. Importance: prevents cash shortage, avoids unnecessary storage costs, and keeps operations smooth. 2. Dividend decision. Dividend decision is about how much profit to distribute to shareholders and how much to retain for business growth. Example, a company may retain part of the profit to buy new machinery for expansion and pay a reasonable dividend to keep shareholders happy. Importance: balances shareholder satisfaction with long-term growth, ensuring funds are available for investments. 3. Organization of finance function. This refers to structuring the finance department and defining roles to manage financial activities efficiently. Example, a finance department may have separate teams for budgeting, accounting, investments, and cash management, all coordinated by the financial manager. Importance: clear organization ensures smooth financial planning, decision-making, and control, reducing errors and improving efficiency. Conclusion: in modern businesses, financial management is not just about profits but about smartly managing resources, ensuring growth, and maximizing shareholders' wealth. Current assets management ensures liquidity and smooth daily operations. Dividend decisions balance immediate shareholder returns and long-term business needs. Organization of finance function creates a system for efficient financial management, accountability, and coordination. By combining these decisions, a business can grow sustainably, reduce risks, and improve overall financial health, making it competitive and profitable in the long run.